Outs of Annuities and everything that you need to know about them, it's a good idea to watch the intro to annuities before you check out this video. There are some details in there that we don't cover in here. And as always, we're going to start off with those 3 things that are important to remember about annuities. The first one is that they are like a mortgage. You in this case are the lender, or the annuitant is the lender, but they are very similar to a mortgage. They are a set and forget product. And they are really great for beginner investors because they're so easy to understand, and then of course because they're a set and forget product. So we're going to go through a general overview of annuities and some important things to know about them. So there are 2 types of annuities, a payout annuity and an accumulation or deferred annuity. The details about those we covered in the Intro to Annuities presentation. You do receive an annual payment or an annual income from annuities, and now although the payment is set up as an annual payment, you can receive that money monthly or quarterly or semi-annually. They are funded by a lump sum, either from a registered or a non-registered investment, or you can set up regular deposits into an annuity, and the payment part of the annuity would not start until after the last deposit. The income can increase or decrease during that sort of period of regular deposits. They are available for one life or more than one life. So there's single or joint annuities. Joint life tend to be more expensive, and it is important to remember that what happens in those joint annuities is when one of the 2 people pass away, the second person continues to receive an income. Now that person can continue to receive the income at the same amount, or they can start to receive a lower amount. And typically people go for that lower amount. It sort of gives you a little bit more time in terms of how long your money will last. And there are guarantees affiliated with annuities, and guarantees are extremely important. If you need more details about them, check out 3.5 in your segregated fund module. And guarantees basically take away some of that risk with the loss of capital. If the beneficiary dies during that guarantee period, they will continue to receive the income for whatever's remaining in that period. So for example, if you have a 15-year guarantee and the annuitant passes away at the 10-year, then there will be continued payments for that remaining 5 years. Now, they're usually set up in terms of years 5, 10, 15, 20 years, and a term policy is actually guaranteed for the entire period, so there is no loss of capital with that one. Now, there is a capital protection guarantee, and what that is it's an option on an annuity, and if this is chosen, if this does need to be used, the difference between the payments received and the initial capital is what's paid out to whoever that end beneficiary ends up being. And they can be paid out in 2 different ways, either a cash refund annuity, which is a lump sum, or an installment refund annuity, which is installment. So you would continue to sort of receive those installments as part of the annuity. So either one is possible, and that's part of the capital protection guarantee. We're going to talk a little bit about the duration, so how long annuities last for. We were talking a little bit about this earlier, so there are 3 options. The first one being lifetime. So your annuity can last for your entire life, from the time that you set it up, day 1 of the payment period, to the time that the annuitant passes away. The second is a term certain annuity, and a term certain annuity is set up for a fixed period of time, and during that period the money is paid out as income. And so you can possibly outlive the amount of money that you have or the term that you've set up in a term certain annuity. So it is important to remember that that's sort of a temporary annuity, what you're setting up. It's not for your life. There is an end date to that. The third one is called a shortened life annuity, or some people may be familiar with impaired life annuity. And this is specifically for somebody who either has an illness or disability that prevents them from living to their full life expectancy. And so what happens with these is more money is paid up front. And so that means that those payments that you're receiving, the regular income that you're getting annually or monthly or quarterly, that amount would be higher because the likeliness is that that individual is not going to be able to meet their life expectancy. So let's say, for example, somebody's life expectancy is 60 years, but because of their illness or disability, they only have 30 years. So it's cut in half. Their payments, therefore, take that into consideration, and so they would receive more money through those payments because they're expected to pass away after 30 years. And now these policies are underwritten. Now they're not underwritten in order to qualify for them. It's not a medical underwriting. You do automatically qualify in terms of that, but it is underwritten in order to establish the possible lifespan of that individual and to ensure that they actually do have a shortened lifespan and they're not just trying to get more money out of the annuity. So this is not about acceptance, it's to make sure that that person does have an illness or disability that will prevent them from living a long life or the full life expectancy for someone of their age. And income. So there are a few different ways that you can receive income from an annuity. The two primary ways that you can receive income are either immediately or deferred. So in an immediate income situation, the income starts on the next payment date from the contract. So whether that's the following month, 3 months, so quarterly, semi-annually, or in a year. And so that date from the time the contract signed, whenever that next payment date is. So if you set up your payments to be quarterly, then your next payment date would be in the next quarter. And then for deferred, that income starts in a period that's greater than a year. And this is usually affiliated with sort of that accumulation in the income phases that we talk about with the accumulation and deferred annuities. So longer than a year for deferred income. There are three ways that you can receive that money in terms of the amount of money that you're receiving or the amount of income that you're receiving. We're going to start at the bottom here with the easiest one, which is fixed income. So that means that you set it, you know exactly how much money you're getting. It doesn't change ever. It's always the same. So if you're getting $1,000 a month, that $1,000 remains $1,000 a month for the duration of your annuity, whether it has a set term or whether it's for the rest of your life. The next one is indexed, and that increases up to a capped amount with inflation. So the point of this one is so that your purchasing power is not eroded by inflation. And so this is set up, you know initially what that capped amount is. So let's say they say, okay, your annuity is going to be a 3%, indexed at 3%, and so your income will be indexed at 3% every single time that you receive it. So every year it is increasing. Like I said, it's a great option because it retains your purchasing power. So that sort of eliminates some of the risk that's affiliated with annuities. The last one is a variable annuity. And this is linked to market performance. So the returns or the income that you get are actually linked to the market performance, an index like TSX or something like that. The owner chooses the investment investment mix, and there is definitely a risk with this one. The income can increase or decrease based on what's happening in the market. So you do have the benefit of not losing out when the market is doing well and interest rates are going up, but you do also have to take on that risk when the market starts to go down and you lose some of that money. So it's important to keep that in mind. This particular option is less of a set and forget option. Now, we talked about income, so getting your money out. How can you get all of your money out? Now, this is a little bit more limited. Annuities really are not the type of product that is set up to take out money whenever you want. So withdrawals you can make them, but there are penalties, and those penalties are based on market value adjustments, or MVAs. And MVAs are based on interest rates, expenses, so the insurer's expenses, and then how much time that annuity has until maturity. So they can vary, and they can be quite costly. The surrender option really is very limited. If you have a term policy, it might be possible to surrender that policy for the commuted value. So that basically means all the future payments, you receive them in a lump sum, whatever's remaining. So if you are in a 20-year annuity and you'd like to receive, you're in a 20-year annuity and you're at year 15, you want to receive those next 5 years in a lump sum, that could be possible. On the other hand, a lifetime annuity cannot be surrendered after the payments start. So as soon as you start receiving income, you cannot cancel that policy. You cannot surrender it and get any money out. Sometimes it is possible to surrender the policy before the income starts, but that really is based on the insurer. I'm going to quickly go through the different tax affiliated with annuities. Annuities, like every type of investment, do have some sort of tax treatment applied to them, just sort of based on what annuity that you are signed up for. So remember, with annuities, the accumulation annuities, they are growing initially, and so that growth is taxed annually. However, that's only for non-registered annuities. Registered annuities, of course, are taxed when payments are being received. So those payments in registered annuity are taxed as income. There are some different tax treatments applied to annuities based on where the money has come from. So a LIF, a LIRA, a DPSP, an RPP, withholding tax is applied to both the payments and the withdrawals. Whereas with a RIF, with RIF payments, only the amounts above and beyond the annual minimum are subject to withholding tax. Now, non-registered has two types of tax applications. Either way, the interest on the payments is taxed as income. That capital has already been taxed. And regardless of that payment method, or regardless of the way that you're receiving the income and the tax treatment you've asked for, the amount of tax that you pay over the length of the annuity is always the same. So there's prescribed and accrual. Prescribed annuities, they are known to have level payments, so this means that it pays the same amount of interest and capital over the length of the annuity. So regardless of what's happening within the annuity and when it's growing, the annuitant is always receiving the same amount. And as a result, their tax is always the same. Now, there are some rules that need to be followed in order to qualify for a prescribed annuity. The first is the same annuitant and policy owner, unless there's a joint policy with a spouse or a sibling. The payments must start before December 31st of the following year, and there cannot be any indexing. The second type, accrual, is taxed annually. There are higher interest payments early and higher tax, and it decreases, that does decrease over time. And the last two pieces of taxation that we're going to go through is the surrender and the guarantees piece. So the surrender, that's when you surrender your annuity and you take out all your money. Now, you remember there are limited options in terms of surrendering a policy. So when you surrender the policy, the tax on the investment growth, the investment growth is taxed. Unless it's a registered investment, and then in that case, 100% of what you get back, that entire lump sum, will be taxed as interest. And then there are guarantees. So when guarantees are actually used, so the annuitant passes away, there are two options: the installment and the lump sum payout. And so for the installment payout, the taxable portion is the same as what the deceased annuitant was receiving. So, for example, let's say this deceased annuitant was receiving a taxable amount of $70, and that would be the same amount that the beneficiary who receives that money would be receiving as well, as part of the installment. The lump sum is when you receive all that money at once, and the amount that's taxed is above the ACV. So whatever the difference is between the ACV and the lump sum is, that's taxed to the annuitant, to the beneficiary, not to the annuitant. Annuity rates. So this is the last piece that we're sort of going to go through in terms of annuities. And annuity rate is extremely important because really this is how much money am I going to receive? What is it based on? How do I know I'm going to get more than the next person? What insurer should I go with? Different insurers obviously offer different annuity rates. And these are based on varying things. Interest rate, personal situation, contract details, and we're going to sort of dive into all of those different details right now. So interest rate, that is set based on the prevailing interest rate. So the interest rates that are offered by other interest-bearing investments at that time are taken into account at this time. And that interest rate, once it's set and once it's decided on for the annuity, like we've been saying, it does not change. It remains exactly the same. There are no changes in it unless you're in one of those options that we mentioned, the index or the market-linked one, the variable annuity. Age, so that changes the payment amount. The older the annuitant, the higher the payment, and that's because there's less time for those payments to be made. So the older that you are, the closer, unfortunately, to death you are, and so the insurer is going to give you more money because they know they have less time to pay out that money. Gender also changes the payment amount. Women get a lower payment because they have a longer life expectancy than men do, and so their payment amount will be less than a man who is the exact same age as them. The deposit amount is the initial deposit that you're putting into that annuity. And annuities are really like anything in life. The more that you buy, the better deal you get. And so the higher annuity rates are given to larger deposits that are put into annuities. The payment schedule, so this is whether you're receiving your money annually, monthly, quarterly, etc. And of course, as with any type of investment, the longer that you leave it in, the better it is. There's more time to invest, more time to grow, more time for the insurance company to sort of make some money off of that investment or that capital that you've given them. And so annual payments are higher than monthly payments. Not by a lot, but by a little bit. The length of the payment period. So of course, a 20-year, if you have $100,000 and you put that into a 20-year term annuity and you take that same $100 and you put it into a lifetime term annuity, the amount of time is significantly different. And so the lifetime is going to have a much longer period, and so therefore lower payments because the insurance company needs to make sure that they have enough money to continue paying for an extended period of time, whereas with a 20-year, it's a shorter period of time, so you will get more money off of that. So those are sort of all of the details of what covers the annuity rate and how the insurer figures out what rate they're going to give the investor. And these rates do change on a daily basis, so it's important when you're working with clients to really make sure that you're checking them and giving them the most up-to-date information. The last thing we're going to go through really, really quickly is just we're going to talk briefly about employer-provided annuities, employer-provided pension plans. So this is sort of another way that annuities are used. And what this is about is the employer and employee both invest, and if the employee becomes vested, then they not only get their money, they also get the money that their employer has put in as well. And vesting is usually around 2 years. And this means that if the employee stays 2 years, they'll get their money and the employer's money. If they leave before 2 years, they will only get their money and whatever gains they receive. So this is sort of one way that annuities are used. It's a great way for employers to sort of secure their employees and try to get them to stay for a certain period of time. We'll go into more details about vesting and all of that information in another presentation. If you have any more questions or you need any more details about annuities, please check out your segregated fund module, the other need to know videos, and your study notes.